There are many wise sayings related to money, but two of my favorite are really applicable as they pertain to this lesson. The first pearl of wisdom is Money Never Sleeps, also the title to a poor sequel to the movie Wall Street. However, the idea that money never sleeps is especially important when you consider this second piece of wisdom: put your money to work for you. Now, if you plan to put your money to work for you to make it pay off, and secondly, if money literally and figuratively never sleeps, then put your money's green backside to work for you 24/7, 365 for as many years as possible. Max out its working life. And when it's all said and done, you'll have an even chubbier pile of money waiting for you when it's time to quit working and enjoy what's referred to as your golden years. I'll let you know if those golden years are all they're cracked up to be, as I'll be hitting them long before you, and that's a best case scenario. The idea is that at some point in your life, you will want to retire, but the question will be, do you have enough money to sustain yourself? Undoubtedly, as you get older, you'll learn the joys, responsibilities, and bills of adulthood. And unless you're able to save money during your working life, you will never get to retire because there ain't no free rides for anyone in a free market economy, which means even the oldies need to pay bills and thus will need a source of income or a retirement fund to see them through their later years. Unless you save that pile of money, you'll be working until they roll you into the grave and kick a little dirt on you. Sure, you've heard of Social Security, but that's not a retirement plan. Social Security may pay you a few $100s a month if it even exists by the time you need it, because it's currently projected to be without funds by the time you need it. But even if Social Security weren't facing insolvency and looking like it won't be able to honor its responsibilities, Social Security does not provide enough income for you to enjoy retirement with much of a standard of living. Remember that economics term, standard of living? So today, I want to show you a way to maximize the money you make during your working life so that at some point, future you will thank current you for allowing future you to stop working at some point in your future life and simply enjoy being alive. If we're going to discuss a marketplace in which stock is bought and sold, and somehow you can benefit from this, it would be very helpful to know what this stock is. Stock is simply part ownership in a corporation or company. Now, the word company is a generic term that many think of when you think of the various businesses and stores that you may frequent. However, the word corporation, that appears in our definition for stock and has a very specific legal definition. Our textbook definition of the word is a business organization owned by shareholders but treated by law as though it were owned by one person. So, a corporation is owned by many people who, in this instance, are known as shareholders. Since these shareholders legally own the business, they are entitled to most of the financial benefits of being an owner of a business. However, while shareholders stand to benefit from the ownership of stock when the corporation is successful, their ownership does not entitle them to direct control over the corporation. So if you were a shareholder in Coca-Cola, you would not be able to march into Coca-Cola corporate headquarters and mandate the creation of a new flavor of Coke. Shareholding doesn't entitle you to that type of ownership privileges, unless you say own more than half the shares of a corporation. But that could mean owning billions of a share of a corporation. Corporations have unique structure relative to other businesses, and we'll look at them later in the year. But the big takeaways from this slide are: number one, a share of stock is like a tiny slice of a business that you can own. And number two, as an owner of a corporation, via the purchase of stock, you stand to financially benefit when that corporation in which you own stock performs well. We'll look in a bit at how you stand to benefit financially from the purchase and sale of stock. However, from experience, I can tell that's a matter many students have knowledge of. Where we're going to begin is with the question, why would a successful business open the door to allow you to be a partner? You didn't come up with the idea for the product. You didn't find a better way to make the product. So why allow you part ownership? At this point, most students will make mention that stocks cost money. So you buy into the corporation, giving money to the corporation. You give them this money and they give you part ownership. That is insightful, but it still doesn't answer why the corporation would accept a one-time payment from you and give you a slice of their company, which could remain profitable for decades to come. And you, as part owner, would therefore be entitled to a slice of that action forever due to your slice of ownership. For us, there are really two reasons why corporations are willing to part with a slice of themselves. The first is debts. Many successful and profitable corporations carry debt. They owe money. It doesn't mean that they are about to go bankrupt. Those debts could simply be the result of business deciding to capitalize on access to cheap credit. It could be related to factors involving tax savings. But the bottom line is corporations carry debt and are not in danger of immediate bankruptcy. However, sometimes they sell shares of ownership to gain relief from certain debts. The second reason would be to expand the business. Transitioning your privately owned business into a publicly traded corporation can bring in a giant lump sum of money, which the now publicly traded company can grow their business to a larger, more profitable market. Say you own a factory and you have invented and patented and manufactured the hit new product, the Cap Dabbler. Your growth is steady, but you know that if you could open up an additional store within your state, your Cap Dabbler sales would be sky's the limit. The problem is you don't have the necessary lump sum of money to open up a second or a third Cap Dabbler factory. You are a successful business, but you don't have that kind of additional seed money. It may take years, and by then, who knows what the Cap Dabbler market will be. One way to accumulate that kind of scratch is through an initial public offering of stock. You essentially turn your business into a giant pie and start slicing it into little pieces, sometimes billions with a B, and you sell these little pieces to interested parties. These interested parties are the shareholders who believe you've got a successful business and want a piece of your action. So you, the Cap Dabbler Don that you are now in possession of enough paper to fund the expansion of your business, allowing you to create, well, a small island of wealth. Voila! 3 factories and the Cap Dabbler kingdom has grown stronger. In the previous slide, we saw the makings of a Cap Dabbler empire. But after expansion, many of you would have caught on to the fact that, yeah, the business has expanded and you're making fat stacks, but now you have to cut those shareholders in. True. As the founder of the company, unless you yourself retain shares, you are no longer the owner of the very company you started. Depending on how many shares you retain, you may no longer have a voice in your company. But the fact is, yes, you will now be sharing your pile of money with shareholders. However, the pile of money will have grown into a mountain due to the expansion of the business and its expanding profits. Imagine your favorite pie. Not sure what it is, but imagine it. Now, also, don't be like that kid a couple of years ago who said, I don't like pie. I mean, who doesn't like pie? This kid didn't, but he probably also didn't like his grandma. So, imagine your favorite pie, and you get to choose between this pie, which will be all yours, allowed to eat all by yourself, or feast your eyes on this pie. You can have half of this pie all to yourself. Look, even though it's half a pie, it's a pretty gargantuan half a pie. So the choice is easy. If you, like I, enjoy pie, you take the giant 1/2 compared to the smaller pie that you could keep all to yourself. The same is true from the corporation's perspective. the corporation that sells stock. It may lose ownership, but the wealth generated from the sale of shares of stock makes that a matter of small potatoes or pies. Why buy stock? Well, as many of you know, stock is an investment. You buy stock today, you wait some time, often many years, and later sell it for more than what you purchased it for. The stock market is not a get rich quick scheme. You are not going to double your money overnight. And anyone who tells you you can has bad intentions for you. Yeah, in 10 years, it's reasonable and possible, but also not a guarantee. Stocks are not lottery tickets. You don't buy them today and the next month find yourself chillaxing on your own tropical island paradise. No, the idea behind an investment is that you are in it for the long haul. This is not rent money or car payment money that you need at the end of the month. This is money that you purposely set aside. This is money that you want to put to work for you so that in the future, one day, you no longer have to work. You can retire and live off the value of your investments. So understand that the idea is yes, buy low and sell high. However, it's not a 2-week, 6-month process in which you hold on to the investment. You need to be able to do that with your money for 5, 10 years if you're looking to double it, or potentially longer. Because, as many of you know, the stock market is volatile. It fluctuates, it goes up, it goes down. However, if you can stay in it for the long run, you are less likely to take it on the chin during one of those inevitable dips in the market. This process of buying stock at a low price and then selling them later at a higher price is known as capital gain. Also, know there is such a thing as capital loss. So, as an example of capital gain, let's say you buy one share of stock at $30 a share. Over the next 5-year period, that share of stock, through action of supply and demand, reaches a value of $50 a share. You decide to sell. You profit. Do the math here. It's not big time math, but you can add the denominator, divide by 0, and that's right, you find yourself with $20. Not exactly, forget you, boss man, I quit and I'm going to go sip umbrella drinks at the beach for the rest of my days kind of money. But think about this. What did you have to do to come upon this money? Nothing, right? You didn't have to work a second shift. You didn't have to burn a single calorie. You simply had to be willing to do without a sum of money for a period of time. And 5 years down the road, you've done more with it than if you had stuffed it under your mattress. Now, also think about this. What if you hadn't bought a single share? Now, in total honesty, you can buy a single share. However, that's kind of like going into McDonald's and asking to buy a single fry. Not quite the same, but they live in the same zip code, if you know what I mean. So, what if instead of buying a single share, you bought 100 shares? Then you'd be looking at a much more handsome $2,000 profit, which I don't imagine anyone in here would take a pass on. Not buy an island and retire into relaxation and luxury kind of money, but a significant sum of money nonetheless, for which, again, you didn't have to lift a single finger or burn a single physical or mental calorie. The other manner in which you can profit from purchase of stock, aside from capital gains, are dividends. As part owner of a corporation, you're entitled to a portion of that corporation's earnings. This would come via a corporation choosing to pay its shareholders a dividend. Not all companies pay shareholders dividends. One of the reasons they do it is to attract shareholders, drive up interest in their stock. But not all corporations do that. So if dividends, a regular payment every year, or every 6 months, or every 4 months, as some corporations will pay them quarterly, if that's important to you as an investor, then carefully review whether or not the corporation you're investing in offers dividends. And if so, how often do they pay them? Dividends don't normally make the difference in our yearly classroom stock market contest, so I wouldn't make that a deciding factor when choosing your investments for our classroom contest. However, in the real world, dividends and companies that pay them can help supplement a retirement income if you choose corporations that do make some regularly scheduled payment to their shareholders. Here's an oversimplified explanation of dividends. Imagine that the Apple Corporation was divided into 25 shares. Remember that corporations are generally divided into millions or billions of shares. And you own one of these shares. There it is in the upper left-hand corner. Now, if you own one of 25 shares and Apple decided to pay its shareholders dividends, what share of the yearly or quarterly profits would you as a shareholder be entitled to? Yes, you would be entitled to 1/25th or 4% of the profits as a 4% shareholder. Now, most people would hear 4% and think, poppycock, what am I going to do with 4%? Well, when you consider Apple's net profit in 2019 was $55 billion, 4% doesn't sound so measly now. That's a couple $1 billion, and I don't know about you, but I'll happily take a couple of $1 billion. Who am I kidding? I'll take $2. So here you can see a visual representation of Facebook shares. When Facebook transitioned from a privately owned company into a publicly traded company in 2012, they introduced close to 3 billion shares, each initially offered at $38 a share. Here you can see who owns those shares, or at least who did own those shares. Who is the majority shareholder? A man by the name of Mark Zuckerberg, who also happens to be the founder and current CEO of Facebook. According to this graphic, he owns 24% of the corporation. Why do you suppose he keeps these shares? According to this graphic, those shares used to have a value of $12 billion. Today, it's probably significantly more. So why keep them? What would happen if Mark Zuckerberg sold all those shares? Would he have any control relative to Facebook? No, he wouldn't. Shares equal ownership, and the more shares, and currently Zuckerberg is the shareholder with the single most shares, the more shares, the more influence you have. If Zuckerberg were to sell all his shares, he'd lose his pull with Facebook. And as of right now, I believe all indications point to Mark Zuckerberg, lizard person or not, still having a vision for what he wants Facebook to be and or become, hence the control of a majority of shares in the corporation. If you've been paying attention, you've probably picked up on my not so subtle playing the part of male cheerleader for the stock market. And now we're going to see why. Understand that first, there is risk involved with the stock market. However, it's manageable risk. There are very few guarantees in life, and unfortunately, the stock market is not one of those guarantees. However, the stock market, while not guaranteed, is a relatively safe gambit, and what makes it more appealing is the fact that you're not going to find a better return on your investment compared to what the stock market offers. During the past 100 years, which is a pretty long sample size for a time period, the average rate of return in the stock market was 6%. This does not mean that every stock goes up 6% every year. Some go up, and yes, others will go down. However, when you look at all the stocks and factor up their ups and downs, you see an average return of approximately 6%, meaning if you invest $1,000 in the stock market at the end of the year, if the market performs on average, well, you would have an additional $60. This is not buy an island and relax money. But the question becomes, if you weren't going to spend this $1,000 and you were wise enough to understand the concept of putting your money to work for you, where else might you have put your money? Most people smartly point out that you could choose to put your money in a savings account in the bank. That approach does have merit. So let's look at that. Currently, the interest earned on a savings account is less than 1%. However, for simple math, let's say you find a bank willing to pay you 1% interest on your savings account. If you put that same $1,000 that you used to invest in the stock market and you take it and put it into a savings account, let's compare it to how it performed in the stock market. At the end of the year, you'd have an additional $10. Now, I'm pretty sure you're like me, and when offered the choice between $60 and $10, you're taking the 3 Andrew Jacksons. That's why the stock market beats the bank. If you have money that you are not needing at the end of the month or the end of the year, and you can take the time to ride out the highs and especially the lows the stock market will inevitably go through, then you stand to make significantly more with your money putting it to work in the stock market. However, remember the big difference between the stock market and the bank. The 1% you get from the bank is a guarantee. While there is risk associated with the stock market, you aren't guaranteed that 6%. Some years it might be more, and some years you might actually lose. However, the law of averages says if you play the game long enough, you too should see a return in the neighborhood of 6%. So, use the market in the right way and for the right reasons, and you'll stand to benefit financially. However, take this month's car payment and bet it on Amazon, and who knows? At the end of the month, a very short time in the market, you could find yourself in a very disadvantageous position. On this side, we see another enemy in your fight to squirrel away money for your eventual retirement, and that's inflation. Inflation isn't a term we've discussed yet, but nonetheless, some of you have heard about it. Inflation refers to the fact that prices are always rising. We don't always notice it because it's usually a few cents this month, a few cents next month, and so on and so forth. Well, over time, all these increases add up to a more significant and noticeable price increase. So the additional challenge in saving money is outpacing the rate of inflation. This graphic attempts to show you what you're up against. Imagine you being a responsible person and stashing $1,000 in a shoebox and being disciplined enough not to touch it for 25 years. How much money will you have in 25 years? Well, if you don't touch the money, you have $1,000. However, and this is a big however, your $1,000 after 25 years won't allow you to buy as much stuff as when you put that money in the box 25 years ago. And that's because of inflation. According to the graphic, if the rate of inflation holds steady at 4% during those 25 years, how much purchasing power do you have with your $1,000 after 25 years? According to the graphic, that same $1,000 25 years later will only be able to buy you about $368 in goods because the price of most goods and services will have gone up due to inflation. So another reason to wisely invest your money and take advantage of the stock markets and the historical 6% return is the constant battle with inflation. So to show you the other side, let's look at this historic stock market slide, which took place in 2007, 2009. During that 2-year bear market, and you'll be hearing a reference to the bear later, some stock indices slid as much as 56%. Imagine you're a proud first-time investor, making your first investments on September of 2007. Only 2 years later, see half your initial investment staring you in the face. Well, as is often the case, the market corrects itself, and you'll see that in the next few slides. Imagine having invested $1,000 in Mickey D's back in 2008. Today, that investment would be worth 4 times as much. Don't like fast food? I don't blame you. However, as far as an investment, it can be healthy. Now, how about Nike? Interested in quintupling your money in 10 years? What about turning $1,000 into $22,000? Almost 23. Amazon did that. There's also a little company that some of you may have heard of, Netflix. Check this out. $1,000 invested in 2009, 10 years later was worth $60,000. Now that's a return just slightly, said sarcastically, above 6%. When you look to purchase stock, you will generally go through a brokerage firm, as this slide illustrates. The various brokerage firms like Charles Schwab, E-Trade, etc., are the middlemen slash women from whom you'll actually be purchasing your stock. Generally, the corporation will sell shares to various brokerage houses, who in turn around and sell them to you. And when the time comes to sell your shares, you don't have to find an individual buyer to take the stock off your hands and convert it to money. Instead, you put in a sell order, and the brokerage firm will take your stocks off your hands at the current market price. There are three major stock exchanges in this country. Each one is a little unique. But each one offers a sort of seal of approval, meaning if the company you are looking to invest in is listed in one of these three major exchanges, it means they are stamped with a seal of credibility. Not invulnerability, but credibility, meaning there is a sense of legitimacy that surrounds the company listed in these exchanges. Because in order to be listed on one of these exchanges, companies have to have demonstrated a certain degree of business success in order to be listed on these markets. Corporations that don't meet these financial benchmarks can still be bought and sold as OTC or over the counter stocks, but that means they don't come with the seal of approval afforded by being listed on one of the exchanges we're about to mention. Coincidentally, once we begin our stock market contest, you will be limited to buying stock listed on these three major markets. So, over the counter stocks, as well as those traded on foreign exchanges, and yes, other countries do have exchanges, those stocks will not be fair game in our contest. It doesn't make them bad investments in the real world, but our contest is limited to the following three exchanges. The first exchange is the granddaddy of them all, the NYSE, which stands for New York Stock Exchange and is pictured in the slide background. It has been around the longest of the three major markets, and in order to be listed on the NYSE, stock corporations must meet certain size and profitability criteria before being listed on the NYSE. This gives you, the investor, a certain sense of security, which, once again, doesn't mean the companies listed here are bulletproof. Have any NYSE companies gone poof? Sure, check Enron or Washington Mutual. But the NYSE listing means the corporation you're investing in has been vetted to a certain extent and is not a fly-by-night operation. Currently, there are over 3,000 companies listed on the NYSE. Here you can see the trading pit, which is one of the aspects of the NYSE that people find interesting. This isn't the actual NYSE pit, but is close enough in approximation. Notice all the brokers in the brightly colored vests that indicate which brokerage firm they work for. These pit traders use an intricate form of sign language to communicate amidst the cacophony of sound and action that fills the pit. When the closing bell rings, this hive of energy and noise grows eerily quiet. Here's a portion of the sign language all pit traders are required to know. You too will be required to pass the New York Trading Pit's hand signal test before passing 8th grade. Just kidding. The second major US market is the NASDAQ. Here's the point where I usually offer a 1-pound bag of Jolly Ranchers to anyone who can tell us what NASDAQ stands for. Needless to say, we get some pretty interesting answers. NASDAQ actually stands for, and you don't need to know this, National Association of Securities Dealers Automated Quotations. And now you can see why they use an acronym. National Association refers to the fact that NASDAQ stocks can be bought and sold through this association anywhere in the United States, quite frankly, possibly the world. Securities are a fancy word for stocks. So we have the nationwide group of stock dealers And then we have a reference to automated quotations. Automated quotations is a reference to the fact that since its inception, all NASDAQ stocks have been bought and sold electronically. Today, this doesn't seem too radical as most stocks are traded in this fashion. Even the hustle and bustle of the famed NYSE trading pit is going the way of the dinosaur as more and more trades are conducted electronically. But the automated quotations refers to this electronic trading format that, when first introduced in the 1970s, was kind of science fiction. Additionally, as the NASDAQ was building its street cred, it became the listing location for a lot of tech stocks, which again, back in the 1970s and 80s, was also not everyone's cup of tea. Fast forward to today, and the NASDAQ has positioned itself firmly behind the NYSE in terms of respect and credibility. There used to be a time that once a company met the requirements to jump from the NASDAQ to the NYSE, many corporations did this because it was seen as a step up. However, today, movement from the NASDAQ to the NYSE is less of a big deal. Currently, there are over 5,000 companies traded on this market, and it still does have a heavy tech sector. The last major US stock exchange is the Amex, which is short for the American Stock Exchange. Don't confuse the American Stock Exchange Amex with the credit card, the American Express, which is oftentimes green, has a picture of a gladiator or a centurion on it, and is also called an Amex. The Amex we're talking about here is the American Stock Exchange. It was created in 1842 and was formerly known as the New York Curb Exchange because before they were the third largest US stock exchange, the New York Curb Exchange used to conduct its business on the street corner curb near where the big boys played on the NYSE. Today, the Amex is no longer known as the Curb Exchange, and they even have their very own indoor facility that allows them to conduct business like the other sophisticated aristocrats. There are over 700 corporations traded on the Amex, making it the third largest in terms of size within the United States. The two animals one may occasionally hear about if discussion turns to Wall Street or stocks or the stock market are the bull and the bear. These animals, one good and one bad, are used to discuss ongoing trends up or down as can be observed by taking a big picture view of the stock market as a whole. The first is the bull. This refers to a time period, generally 2 to 3 months or more, during which the stock market goes up 20% or more. Remember, the average return is 6%. So when you hear the bull is loose on Wall Street, despite what the amateur economist may be visualizing, a giant Texas longhorn unleashing untold carnage upon brightly vested stock traders, when you hear the bull is loose on Wall Street, the bull is good. On the flip side, there is the bear. The bear signifies a 20% or more drop during a sustained period of 2 months or more. People often ask why the bull and the bear. The honest answer is there is no consensus on the origin. However, the one that is most colorful and therefore perhaps the most memorable comes down to something like this. Remember, in your lifetime, and it's not a matter of if, but rather when, you will be attacked by a bear and also quite possibly a bull. Although both occurring is rather statistically improbable. It's just science, folks. When you're attacked by a bear, you will vividly see the bear rear up on its hind legs before swiping down with its giant bear paw and spilling your insides onto your new shoes. So the bear swipes down, and a market that is a bear market is one headed down. And the bull, statistically unlikely, you'll have to battle both these creatures in your lifetime, but still mathematically possible. When the bull attacks you, he will attempt to toss you up in the air, and in the air, gore you with his horns. So, horns up, stock market is up. Now, understand these are trends. When we're in the midst of a bull market, not every stock is up 20% or more. Some may be up more than 20%, others less, and still others, although not the majority, may be experiencing a loss. Likewise, a bear market does not mean you can't still pick a winner and ride out the rough tide with your other stocks. This is why it's often said bulls and bears make money, but pigs get slaughtered. Find opportunity during the good and the bad times. However, avoid getting greedy, reaching for something that sounds too good to be true, and instead ending up on the slaughterhouse hook. Oink, oink.